Good afternoon, ladies and gentlemen. Welcome in our workshop on sustainable finance. I'm Kathleen van Bremp. I'm your host in this workshop. MEP in this Parliament and one of the co-organisers of the overall event, together with colleagues from other political groups. And I think I have to say, although we're not too many in this workshop, but it's the quality that counts, especially when it goes about finances. The overall goal of this conference is getting the change in paradigm, how we look at our economy, how we look at growth in our societies, Europe, but also the rest of the world, because tomorrow I will be chairing a workshop on trade, which is equally important as finance. They're all parts of changing that paradigm. It is, of course, important to talk about how can we achieve that. And we all know that we will need, only in Europe, billions and billions of extra investment money to make that change happen, to make sure that we have 100% renewable energy, that we have a full circular economy, that we have net zero emissions by 2050. We can do that, but it will take an awful lot of efforts. And these efforts in our society and political life, they go hand in hand with the money that we have available. And in that sense, this workshop is extremely important. And I have three excellent speakers. And I would like to first give the floor to Maarten Spolc, who is the head of the unit DG Visma, responsible in the European Commission for Capital Market Union and Sustainable Finance. And the Commission started working on that with a clear goal. I give you the floor to outline, and then I think it's up to the two other excellent speakers that I have today to comment on that, whether or not what we're doing at the level of the European Commission and now in the European Parliament, whether that's a good starting point, but is it also ambitious enough to really change that paradigm around? But I gladly give first the floor to Maarten, please.
Thank you very much, Kathleen, and good afternoon to everyone. It's a pleasure to be here. I think that the topic is extremely timely. There are a few buzzwords that I hear around. Obviously, sustainability is the first one, which is obviously at the core of the Commission's priorities. I mean, when it comes to the budget, obviously all the different policies. But a big buzzword is sustainable finance. And what sustainable finance means is, again, how to reorient capital flows into sustainable investments. Well, the rationale and the justification why it's so important is that there are indeed huge investment needs that need to be done to put our economy on a sustainable path. And sustainability obviously has three dimensions: environmental, which also includes climate; social, I should really emphasize social; and governance aspects. Now, just only on environment, the needs that we have identified that needs to be basically financed and funded in terms of infrastructure and investments are basically 180 billion yearly. Now, this amount of money cannot be obviously financed by public sector only. By the way, this number, that I quoted, is just one of the estimates. There are obviously other estimates. Some of them are even higher than that. But, I just wanted to demonstrate the fact that this gap cannot be financed by public money only. So we spent some time in the European Commission on how to mobilize also the money that investors, institutional investors, asset managers, the private sector has, and also we, all of us, retail investors, pensioners, etc., how to mobilize and shift the recent trend still to put your money in a bank and to rather move it into a more productive investment. Now, we thought a lot about it. Also, in the context of the 10 years anniversary of the Lehman Brothers collapse, we have done a lot, to fix the financial sector, sins and problems, but we would like to turn the page. And now we would like to offer the financial sector actually an opportunity to contribute, to be part of a solution rather than to be the problem, as we have always seen. And for us, in order to mobilize this money, we really think that a fundamental, comprehensive shift in how the financial system works is needed. And not only in terms of how the financial sector works, I mean the investors community, but also the policy framework needs to be adjusted. So my Vice President Dombrovskis, obviously together with President Juncker, have basically asked us, the bureaucrats, I mean, to come up with idea and vision for how this ambitious plan should be implemented. And in March earlier this year, the Commission, the College of Commissioners adopted a comprehensive plan, comprehensive strategy embedded in our action plan on sustainable finance. I mean, those of you who have not had a chance to read it yet, I mean, I really encourage you to read it. It's called Financing Sustainable Growth. It's basically 15 pages that summarizes 10 main actions. Here, I mean, I understand that my time is limited and I don't want to go in all of them. Here, I just would like to flag 3 objectives. I mean, that was the question that I was asked. The first objective is to reorient capital flows towards a more sustainable economy. Here, as an example, as an action, I would give you a very ambitious proposal to create a unified classification system of activities which we in the European Union might deem to be environmentally sustainable. There are different systems already being in place and used by the industry, but I mean they are different and there are different standards. And we are trying to basically put everything under one roof and develop one single taxonomy that could be also used more broadly. The second objective, I'll try to be short, is to mainstream sustainability into the risk management of the financial institutions and financial sector. This is a reflection of the fact that the huge environmental risks and degradation from climate-related issues, I mean, that we are observing, can have substantial impact on financial stability. So while the first objective, reorient capital flows, is kind of more positive and about opportunities, the second one is about to contain the risks that the environmental degradation poses. And last week, I mean, just accidentally, I mean, I attended the Global Climate Action Summit in San Francisco, where there were many events, also organized for the financial community, about how to contain these risks. And the financial community is increasingly aware that they have to deal with it. The third objective, and again there are many actions under this second objective among many, for instance, that the institutional investors and asset managers have to consider how they comply with their fiduciary duty and disclose appropriate information to the market. The third objective that we have defined is that we need to foster transparency, greater disclosure, not only by the financial sector itself, but also by the corporates. If we want investors to invest more into more sustainable assets, it's also important that the businesses and corporates provide appropriate information. We already have a legislative framework in place in the European Union, but now we are trying to make it clear that this also includes some climate-related information and environmental and social and governance aspects. I don't want to speak for too long, but I mean, just let me finish with the fact that the action plan that we have adopted at the level of the Commission is a combination of legislative actions and non-legislative actions. We believe that this project, I mean, cannot be successful if we only regulate and again, you know, throw a new tons of legislations on the market and the stakeholders. We believe that active engagement and active, proactive involvement of the private sector, of all of us, by the way, of every stakeholder, is absolutely crucial in making this project successful. So for that reason, we don't only focus on the legislative proposals. There we have really proposed basically 3 main ones. I mean, the one that I mentioned on taxonomy, the other one is on fiduciary duty and the disclosure, what asset managers and institutional investors have to disclose, how they comply with the fiduciary duty. And the third proposal that we have adopted in May was to basically develop a benchmark that would help investors to assess the performance of their investment. The other non-legislative actions are super important for us as well, on which we are working together with the stakeholders, again, not only in the financial sector, but also, by the way, in the academic community. I mean, we have a now plan how to reach out to the academic community as well to leverage on their work. And obviously with also the European Parliament and the Council, who are, by the way, I understood, very strongly behind the agenda. So again, I don't want to occupy the space here more than I am allowed to, but I just wanted to send a very strong signal that the Commission really attaches huge importance to this file. We see not only the importance, but also the opportunities that we see in this file, business opportunities. We believe that investors, if they invest in more sustainable investments, this will not necessarily sacrifice the returns. The investor community starts to realize that it will help them to reduce the risk, but ultimately also actually enhance returns, certainly enhance return actually over the medium to long term, and doesn't sacrifice necessarily, at least, I mean, I am happy to hear the evidence from the academic community, doesn't necessarily sacrifice the returns over the short term. And this might ultimately put the European economy on track. Last week in San Francisco, I heard many great examples that happened, by the way, in the US, which is really a kind of bottom-up driven, because there is no support whatsoever, obviously, at the highest level in the US, which we regret, obviously, because the climate change issue is obviously very, very global one. But, I mean, there is a huge wave and huge bottom-up drive for the investment community, I mean, to contribute. And we have seen many examples how basically businesses and investors community reap the potential that this project offers. Last point that I will make, I mentioned that sustainability is about ESG. In our strategy, we put a lot of emphasis on climate, because the climate, obviously, risks are being deemed as the most pressing ones, and if you don't address them, I mean, basically, we might not be talking about other risks soon, unfortunately. So, I mean, the climate risks are really very important to us. Environment as well, and I really would like to emphasize that we are not deprioritizing the social and governance aspects of sustainability. We work on them in parallel, but we are using other means than necessary legislation for the time being. So here I would stop. Thank you very much for your attention, and I would be asked for any questions.
Thank you very much, Martin. And as always, I forgot something practical in the beginning. There's a site, slido.com. You should all join it, get into it, type the hashtag that you see over there, hashtag U892, and then you can ask your questions, and you can also vote other questions up, so they become more important, and I will pick your questions then later on after the introductions. So please do so. It's an easy way to get the questions easy. Okay, let me now give the floor to Rens van Tilburg, who is the Director of Sustainable Finance Lab in the Netherlands. And you once said that finance has the opportunity to make the sustainable economy either to slow down or to speed it up. And you also wrote about the risks of a carbon bubble. So the right person to give the first reaction to what the Commission is doing, and how do you see finance as a key player in going to a sustainable economy. Thank you.
Yes, thank you very much. Thank you very much for having me here. And well, let me start on a positive note, because I think that the European Commission is really making speed with this topic, and I think that's very very important. Actually, it was like a little bit over 4 years ago that we gave a presentation here of a report of the Sustainable Finance Lab, which we drafted on the request of the Green fraction of the European Parliament. And they asked us to look into the risk for the European financial system of the carbon bubble. Well, our finding at the time was that if we would start the transition quickly, there would definitely be losses, some large losses, especially with UK pension funds, with some French banks, and well, we looked at what holdings they were having. But for the financial system as a whole, we said it is doable. It will not destabilize the whole system. And at first, the people of the Greens who commissioned us with the topic, they were a bit saddened about that, because they thought, well, we're going to have a report showing that the financial system will collapse. But we said, well, maybe you should be happy with this, because it means that we can make the transition without destabilizing the financial system, and that takes an important argument against environmental measures off the table. However, at the same time, we also found, and that was something that in the research I found one of the most astonishing findings for me personally, was that the fossil fuel sector is investing, and it still does, 350 to 400 billion euros a year in discovering new reserves of fossil fuels and making them ready for exploration. And in that sense, those are such large amounts that every year that we wait with making the transition and we keep on investing in those fossil fuels, the financial risk is actually building. And when we came out with that report 4 years ago, it was really, there was very little around. So also in the Dutch parliament, questions were being asked, especially about the Dutch pension funds and banks, to the Minister of Finance. How do you see this risk? And well, he didn't know, so he put the question to the Dutch Central Bank, and they said, well, it's not such a big risk. And here we are, 4 years later, and we have currently draft regulations on the table. Tomorrow I'm again going to the Dutch Central Bank, where we, for 2 years now already, are giving college to all new central bankers about this topic. So they really are. I see that regulators, policymakers are really taking up the topic, and at the same time. I think one of the things I think is very laudable of the European Commission is that they clearly state we signed the Paris Agreement, that's what we want to achieve. For that we need these 180 billion a year on investments. And of course the big question is, with the current package on the table, are we also going to get there? And then I am much less positive. So I think it's the action plan we have on the table, it's a good first step. And then in the rest of my presentation, I want to mainly point out what I think we can do to strengthen this. And that will be along two lines. So the one is more on the current regulations on the table. How can we make those stronger and better working for reaching the objectives that no one is really questioning. And at the same time, I think there is a much broader agenda, which you can say we need to change finance in order to finance change. And that is, I think, almost off the table. So a lot has been discussed also here in the European Parliament over the last 10 years of how we needed to reform the financial system. And some good things have come out of that. But in essence, I think you can read that also now in the Financial Times, The Economist. So in that sense, it's not a very niche kind of view, is that in essence the financial system as we have it is not that much changed. So there is still a dynamic which can lead easily to a next financial crisis. And before that, we have a build-up of a lot of investments in not so productive sectors. And that means that a lot of the money is not going to the energy transition that it needs to go to, but it goes into all kinds of bubbles, often in real estate, but also in other markets. So then to start with the sustainable finance package itself, I think what is a problem with it is also that it's always a bit unclear to me with what kind of perspective the regulation is being drafted. Because what we have seen over the last few years is that thinking along the line of financial risk, actually, so climate-related financial risk, has been very fruitful. And so that has been really the trigger for regulators like central banks to take this onto their agenda. For some financial institutions to become more aware of it. But if you look at the regulations from the European Commission, it is much more about we have signed the Paris Agreement and there's a reason, so we want to achieve that. So it's more about the positive impact of these investments rather than this risk perspective. While I think it's very good to also take that perspective into account, it's a perspective that financial regulators find much harder to take into account because they have a mandate which is centering on financial stability and therefore risk. And I think the European Commission indeed does have this much broader mandate. So it's good that they take it into account. But then if you see how it works out, for instance, in this discussion about the taxonomy, They very much focus now, and actually also with the other proposals, on the investors, not on the banks. Well, I think if you look at the high-level expert group, which drafted sort of like the main philosophy of this whole action plan, they clearly say in order to really make the transition, we need the whole financial system. And especially in Europe, we have a very bank-dependent financial system. So we should not exclude the banks, as been happening now largely with the current proposals. And then if you look at the taxonomy, now it's mostly or almost exclusively about identifying where a positive sustainability impact is. While if you look at the whole financial system, where are the relevant decisions being taken about the energy transition, it's just as important, if not more important, what are we doing with the so-called brown investments, so the investments in fossil fuels. So I think it's very important with the taxonomy that we really agree on which kind of activities and therefore which firms and which assets are helping in the transition. But we should also identify which investments are really blocking the transition that we need to make. And then there is a question of impact for retail investors. That's important, but also for pension funds, because the people who invest their money in pension funds, they often have from research we know that they want to have a positive impact. So that's a discussion that we have very strongly in the Netherlands, that the pension funds who used to think, well, we are really investing our money for the highest financial return, increasingly they have to look also at the impact in the real world. So we need to have that transparency, but we need to have it on the green and on the brown. And I think also it's important to realize that just making things more transparent will not do. So we also need to look at the incentives that are in the financial system. And I think that was my main disappointment when I saw the action plan of the European Commission, was that two questions, or actually proposals that the high-level expert group put on the table were being said, well, we're going to look into that. So I think that is the research agenda. One is about the capital requirements for banks. So there was a discussion, should banks have should they hold less capital for green lending or more for brown lending? And I think that is a very important discussion. I think that really goes to the heart of the incentives that are being felt within the banking sector. And just making things transparent without touching on those incentives will not really make those big financial institutions move too much. So I think I understand that there are many questions, so more research is definitely needed. But I would like to see much more ambition on that one. And the other one is the question with regard to financial markets and the idea that there is a short-termism in that market. There's a lot of research on the table already of the CEOs and CFOs of big companies who say, well, we feel that we are being pressured by our shareholders, by the analysts, that we cannot really invest in long-term value creation. So much that even we forego investments which we think would be financially very profitable in the medium to long term. But we are not able to make those investments. And well, also there it's being said, well, we need more research into that. But a lot of research has already happened into that. I only mentioned the K review in the UK, which came out, I think, 5 or 6 years ago. Well, so I think there's a lot of research there. And of course, this touches upon the politically hardest topics. So in that sense, I mean, politics is about the art of the possible. So I understand that these are hard things to look into, but I think in the end, if we are honest and we really want to make this transition, we need to be looking into these questions as well. Well, and then my last point, because this is what was actually put on the table by the high-level expert group. What they did not really put onto the table were questions about what we have been discussing in this room in the session before extensively, is that the financial sector has this tendency to invest in assets which are not productive. We have seen that happening in all European countries, but also in the US before 2008. Like in the early 90s, what a bank was doing was mainly financing corporations, and that was good because a corporation, they use the loan, they create a growing economy, they are able to pay back that loan. But increasingly what you see is that banks all over the world have actually transformed from mainly lending to companies to mainly lending for mortgages. And the main result of those mortgages have not been the building of new houses. It has mainly been to increase the price of existing assets, of existing houses and commercial real estate. And that is really, I think, the core problem with the financial system in Europe at the moment. Proposals like have been on the table here from the Liikanen report, so the European Commission made proposals on that, and they have not materialized into any real action, and they have been taken off the table. And I think so that's a proposal that we have just made in the Netherlands with the Sustainable Finance Lab. In our analysis, like where are we standing, we say we still need to discuss these public interests that banks are currently made responsible for, which is the reason why we cannot let them fail, which is the reason why they can take all these risks before the crisis. So we need to find another way. If the Liikanen approach of taking the risky things out of the bank is not working, then a good second way to try to do this is to create a safe space for the savings of people, and a public anchored payment system. Because those are two very important public interests that are currently organized within private banks. And one possibility to do that is to have a central bank digital currency. This is an idea that has been around actually for a long time, but it's really getting into the mainstream now. So the Bank of International Settlements drafted a report on this earlier this year. On Sunday we had a big event in the Netherlands for 10 years after the crisis where we discussed this report with the Dutch Central Bank and others. And I think that's a very interesting thing to look at also for the European Commission. And I think, yes, so that's it. So that's why I say there are no niche solutions. You can also read in it there are no nice solutions. I think that we in order to get to real sustainable financial sector, we really should confront also the difficult questions. Thank you.
Absolutely. Already a lot of things to discuss. Thank you very much. I now move to Yannis Dafermos, who's an economy professor at the University of West England, doing research on climate change and finance, ecological macroeconomics, and inequalities. If I'm well informed, you have the floor.
Thank you very much, and I'm very pleased to be here, and thank you very much for organizing this very important session, because I think it's very crucial to talk about the links between climate change and finance. So in my presentation, I would like to give you the big picture about the links between climate change and finance, and I will follow up on many of the points raised by Rens, and I would like to build on these points and say a few more things about the things that we have to do in the next years. And I will also be talking about capital requirements and the suggestions that have been made by the European Commission about the so-called brown penalizing and green supporting factor. But first, I would like to talk a little bit about this big picture. And if we could move to my first slide, if I could summarize what has already been said by the previous speakers. When we talk about these links between climate change and finance, there are two issues that we have to pay attention to. So the first one is about the risks that the climate change could impose on the financial system. And Rens talked about the carbon bubble, and we know that if there is a rapid transition to a low-carbon economy, then there are some financial institutions that have invested a lot in carbon-intensive assets, so there could be a risk there. there is a lot of work about the impact that this carbon bubble could have on the economy. There are some estimations which say that probably this is not very big, but we also need to take into account that we talk about a very interconnected financial system. So in some cases, we expect that this risk could be important, especially if the transition takes place at a very high speed. So these are the so-called transition risks, but we also need to pay attention to the so-called physical risks. So these are the risks related to the fact that in the long run, climate change is going to destroy our economies. We are going to have that in many areas around the globe. There will be typhoons, floods that are going to destroy property, that are going to destroy buildings, and this might have a very systematic effect on the banking system. Why is that the case? Because these firms and these households that will be affected by climate change will not be able to repay their debt. So if we have the same financial system in the next decades as we have right now, we know that this is important. Why? Because if there is such a big impact of climate change on the financial system, and we have a financial system that doesn't work properly and has a lot of problems, we know from the recent financial crisis that this could lead to less credit for investment, and this could lead to higher unemployment. So actually, when we bring the financial system into the picture, what we get is that the climate change effects will be much more important because of the fact that the financial system will be affected a lot in the long run. So we need first to focus on these risks, to understand better these risks. And of course, the second issue is, can we use a financial system in order to facilitate the transition to a low-carbon economy? And this is a discussion that we are having right now, and there are various ways, of course, to do that. So I'm going to talk about this. But when I started working on this issue with my colleagues, what we realized is that it's very important to have a very strong analytical framework in order to be able to analyze these two issues. And I have on the slide the way that we analyze this issue. So we have that the macroeconomy, the financial system, are always part of a bigger ecosystem that actually is necessary in order for our economies to work. And we need to take that into account because, first of all, the ecosystem affects our economies, but at the same time, the financial system affects the way we use energy and matter. So we need to take this into consideration when we discuss these types of things. So in the next slide, what I have is our attempt to formalize these issues, and we have tried to develop a model that makes us able to bring the financial system into the picture. The model talks about the links between the financial system, the macroeconomy, and the ecosystem. And we call it defined because it refers to this dynamic interaction between these three systems. You can find more information on this, about this on our website. But what I'm going to do now is to show you how this framework can be used in order to understand better the way that finance could contribute to sustainability. So in the next slide, I have some projections that we have made about the global atmospheric temperature. So you might know that right now, if we follow a business-as-usual pathway, it's very likely that at the end of this century, the temperature on the Earth will be 4 degrees higher compared to the pre-industrial levels. Right now, we are close to 1 degree higher compared to the pre-industrial levels, but if the transition to a low-carbon economy is very slow, if we don't make big changes in the way that we use matter and energy, we are going to observe, it's very likely that we are going to observe such a big increase in atmospheric temperature. And the question is, how could that affect our societies and our economies? How could that affect the financial system? And actually, the problem is that, as I said before, if we have this big change in the climate system in the next decades, we expect that the financial system will be affected because of a systemic risk in the default rates of households and firms. And we know that when this takes place, this has a lot of implications about our economy. So in the next slide, I have some projections about the way that the default rate of non-financial corporations could evolve in the next decades if we have such a big change in the climate system. So the default rate could increase a lot. There's a lot of uncertainty about that. But what is crucial is that you can see there a trend. You can see that this will go up for many decades. So what does it mean for banks? It means that banks will need a lot of capital. So if we are in the business as usual scenario, and if we have the current framework through which banks are bailed out, it means that there will be a necessity for banks to be bailed out if we have this very high increase in the default rates. So in the business as usual scenario, we are going to observe a very systemic financial crisis related to climate change. We need to think about the way that the financial system could support the transition to a low-carbon economy in order to avoid these types of problems. And this brings me to some suggestions that have been made over the last years. And, of course, the European economy suggestions are part of all these proposals that have been made about the way that we could deal with climate change. So in my next slide, what I have is the possibility of using central banks in order to make a transition to a low-carbon economy. So some of you might know a few things about this idea of having a green quantitative easing. So quantitative easing is a policy that has been used over the last 10 years or so by main central banks around the world in order to support economic activity. And, of course, there have been many critiques to the way that central banks did that. And there have been many suggestions about the possibility of running a green QE. So what does it mean in practice? It means that central banks buy bonds that are issued by corporations that want to invest in green projects, or probably by governments that want to invest in renewables and energy efficiency. So we used our model and our framework in order to understand how this could affect the economy. And we ran a very hypothetical scenario. So let's say that in 2 years from now, many central banks around the globe decide to implement such a program, decide to engage with the problems of climate change and run a green QE program. And the question is, how could that affect the dynamics of temperature that I showed you before? Would we have less atmospheric temperature if we do so? And we ran various scenarios about that. And the key mechanism through which a green QE could affect climate change in practice is by affecting the cost of borrowing for green projects. So by having a green QE, it's likely that those firms that want to invest in energy efficiency, those firms that want to invest in renewables will be able to do so at a lower cost. So if we do that, if we have such a program, in the next slide, I have some projections about the way that this could affect atmospheric temperature. And what we have is that there could be a positive impact. We could reduce the pace of climate change if central banks decide to do so, but we need to take into account that even if we are optimistic about the way that the firm sector will respond to a lower cost of borrowing, still the impact will not be very big. So with the blue rates that I have on the slide shows some uncertainty that we have about that. And even if we assume that the responsiveness will be very high, we cannot get more than 0.5 degrees less compared to a business-as-usual scenario. So it could be a useful policy, but of course it cannot solve the problem. So let me now turn to the suggestions that the European Commission has made about the banking system. And these suggestions have to do with the capital requirements. I would like to show you a few things that we have done about that. So in the next slide, I'm referring to these proposals. So what is the idea behind these so-called green differentiated capital requirements? the idea is actually to adjust the capital requirements of banks based on the loans that they provide to the green economy or to the brown economy. And there are two different versions of this proposal. The first version is the so-called green supporting factor, and the idea is straightforward. If commercial banks provide more loans to green projects, then they will need to hold less capital. Why is that useful? It's useful because then banks have an incentive to provide more loans to the green economy. The other form of this proposal is to have the so-called brown penalizing factor. So instead of asking banks to hold less capital if they provide green loans, the idea with the brown penalizing factor is actually to ask banks to hold more capital if they support, for example, the fossil fuel companies. And there has been a lot of debate about that. My understanding is that initially the European Commission was probably a little bit more in favor of a brown penalizing factor. In the final report, there was more emphasis on the green supporting factor. I suppose that there are still some discussions about that. But what we have tried to do is actually to analyze the advantages and disadvantages of each of these forms of green differentiated capital requirements. And in the next slide, I have summarized some of the positive and the negative aspects of these two proposals. So when we are talking about the green supporting factor, in our simulations that we ran about that, and again we assume that this is adopted by many countries in a hypothetical scenario in the next years. So what we get is that actually a green supporting factor can be useful. Of course it can reduce the pace of climate change because it means that there will be more loans to the green economy. So this is a positive aspect of the green supporting factor. However, there are also some risks related to this proposal. And one risk is that if we have only a green supporting factor, the capital of banks will become lower. So banks will hold less capital when they support the green economy. Now, this might be bad because we know that one of the problems that we had in the crisis 10 years ago was that actually banks didn't hold enough capital. So probably we don't want banks to have problems with their capital because this could make them less stable. And the other risk that we run is that if there is such a green supporting factor, probably in the next years after the implementation of the measure, we might have some support to the green economy, but we might also have the risk of a green credit bubble. And if this takes place, it means that in the long run, probably the provision of loans to the green sector might go down. So we need to take into account both the short run and the long run effects. Now, turning to the brown penalizing factor, the good thing with the brown penalizing factor is that actually banks will be asked to hold more capital. And generally speaking, this is something that is considered to be conducive to stability. But when we are talking about the potential negative effects of a brown penalizing factor, I think we need to talk more about the way that the brown assets will be defined. And this brings me to the point that was raised before about the way that the brown assets can be defined. Because if the brown penalizing factor is implemented, we need to focus a lot on a kind of definition of brown assets. And it's interesting because there is a kind of a trade-off. What is a trade-off? The trade-off is that if we adopt what we call a narrow definition of brown assets, so if we say that brown assets are, for example, all those loans that are provided to fossil fuel companies, in that case, probably the impact on climate change will not be so significant because it will affect only a small proportion of the economy. But if we adopt a broad definition of brown assets, and if we include there not only the projects that have to do with the production of fossil fuel energy, but also projects that contribute to the consumption of this type of energy, then we will have a more positive effect on climate change. But in that case, we might have some more transition costs. So with a broad definition of brown assets, in the next years after the implementation of a kind of a brown penalizing factor proposal, we might have a reduction in economic growth, an increase in unemployment. So we need to take this into consideration. Because right now, our economy is basically a brown economy. Okay, so I will conclude by summarizing the three key messages of my presentation, which are on the next slide. And the first, you can skip that. The first message is that the green transformation of the financial sector is essential. It will contribute to the reduction of climate change, and we have to do this seriously. Of course, we have to take into account that the financial system cannot solve the problem that we have with climate change. And this brings me to the second message, which is that green finance should be viewed as a policy or as a tool that complements government policies about climate change. And when I'm referring to public policies, I'm not only referring to the traditional approach of having some carbon taxes. I think it's very crucial to have plans for public green investment. I think this is something that is missing right now, and we need to focus much more on this. So green finance could play a significant role, but it could not replace these types of policies. And of course, if we look, when we tried to find a way in our projections to achieve the 2 degrees Celsius that we have as a target right now, it's very difficult to achieve that if we have very high growth rates. So we need to realize that low growth rates are necessary, but of course the way that growth will be actually take place in the next years is very important. It is very different when we have green investments compared to the case in which we have brown investments. And the last message, which actually is not directly related to what I said before, but I think it's important to emphasize it here, is that when we are talking about the greening of the financial system, it's more crucial to focus on the traditional banking activities. It's very crucial to focus on the development banks, on cooperative banks. And in my view, it's not a very good idea to extend the greening of the financial system to the so-called shadow banking activities. There have been some suggestions about having green securitization. We know that securitization, shadow banking were used a lot in the pre-crisis period. We know that they create a lot of problems. We know that they actually make the system more fragile. So I think that it's better to focus on more traditional banking and finance activities and not to extend any green finance ideas to the shadow banking system. But I suppose we can discuss more about that later. Thank you very much.
Thank you very much, Yannis, for your very interesting presentation. I have to agree, I'm not a financial expert, just so you all know, but I agree very much with your conclusions. But it's also the other way around. I work more on a daily basis on the government issues, setting the targets on climate. And then it is quite frustrating to see that within the financial system or within the European Central Bank, they don't take that into account, or only for a very small part. You discussed the green quantitative easing. It's one of the issues that we should elaborate much more on. I have a lot of questions, but it's not. I'm just going to question one, and then I'm going to. I cannot read that. Sorry. And then I'll pick your questions, but I'll take one because it's been in Rens's and Yannis' reaction on the Commission proposal was a lot of focusing on what is called green supporting factor, and that's new for me, the brown penalizing factor. Since it's not in the proposals of the Commission, can you explain why we stopped with the more soft issues and not going to really changing the banking system, for instance? It's more general, but also into the green supporting factor. How does the Commission look at that issue?
Kathleen, thank you very much for giving me the opportunity because, first of all, I welcome that we have this debate and the Commission welcomes, even hearing suggestions for making our proposals more ambitious. We don't have a problem with that. That's the debate that we should have. But I think that, there have been some issues that I think require some clarifications. I will first start with the issue of the question from Kathleen on the green supporting factor and brown penalizing factor. These are the terms that we have not used in our action plan, but if you read the wording of Action 5, I think it is, carefully, Action 8 on page 9, actually here we cover both. Here we cover risks associated with climate and other environmental factors, and reflect them in prudential requirements, which might be more the brown penalizing factor. We are cryptic about it in the wording. And we are also talking about the possible adoptions or amendments needed to better reflect the risks of sustainable assets held by banks and insurance companies, which is the green supporting factor that my vice president talks more often about, obviously, because this is the avenue that is kind of more positive and enabling. So actually in the work that we are now conducting, and by the way, this is one of the topics on which we are already trying to reach out to academic community, and now we will do it in a structured way shortly, is indeed, exploring both ways, whether the capital requirements should be adjusted this way or that way to better reflect the risks. As an example of the brown aspect, we have recently asked the EBA, the European Banking Authority, to assess exactly the possible need for adjustment upwards in case the banks actually do not take ESG factors sufficiently into account, if they have some assets that might pose some risks. So here, I would really like to deny that we are focusing only one way. Of course, more publicity is being given to the green supporting factor, and also maybe even more concerns, especially also from the European Parliament, by the way, and the Council as well. There are obviously more calls on the brown penalizing factors, but we are looking at both with our work. If I may, very quickly, because there have been so many points that have been raised. What I think, here, we have to remind ourselves that this is indeed not a silver bullet. Sustainable finance is a very important agenda, but indeed there are other tools and measures, tax policies, investment public policies, etc. I didn't mention one which is very important. It is actually in our action plan. It is action number 3, which is on fostering investment in sustainable projects, where we are trying to explore the potential that combination of public and private money offers. And indeed, in our recent proposals that we adopted in June on the InvestEU, you will see a huge emphasis on the need to invest public money in sustainable infrastructure, sustainable investments, and leverage on the private money there. So again, if you haven't seen the proposal, I encourage you to see the huge links between the sustainability agenda and the public finance angle. As Yannis actually very, very nicely said, the issues are complex and they are trade-offs. If there are calls for the Commission to be more ambitious, we are very happy to take it on. And again, we really want to be as ambitious as possible. But at the same time, we also have to be aware of the possible risk of going too fast. Here I would like to mention one aspect, and that actually Rens focused in his presentation exclusively on E. Here we need to be aware that if we go too fast on E, we might actually also create some consequences on S, which might not be necessarily that nice, especially for some part of this House. So when we considered whether, for instance, we would like to, propose a negative or a brown taxonomy, we did consider that, obviously, in our work, because it would accelerate the pace, it would increase the ambition. But we concluded that just 1 month after the HLEC report was published, the high-level expert group was published, we presented our action plan, we simply concluded that we are not able to say confidently, on the basis of evidence, that if we propose the brown taxonomy, that it might not have huge negative impact on part of the industry, on part of the society, in the member states, etc. And we are a responsible institution. We are subject to the better regulation guidelines and principles. This House is insisting on so much. If you read the impact assessment that underlines the proposal on taxonomy, actually the original proposals of the pre-drafts were actually much more ambitious. But while going through the regulatory scrutiny board, and here I don't blame the regulatory scrutiny board, I just emphasize the point that all our policies have to be evidence-based, the regulatory scrutiny board actually asked us, look, maybe hold a minute, you have to consider this and that before you actually proceed. And we believe actually it's the right thing to do. But you have to be aware that if we create a list of brown activities or brown sector or brown assets, this might have again, a possible negative consequence and create a risk of stranded assets. This was one of the key comments of the Regulatory Scrutiny Board. Well, we were not able in 1 month after the HLEC report to analyze the risk properly, and that's why, we have resorted to take a rather more cautious approach and to focus on the positive side. And the risk, the effect of E into S is being mentioned a lot. Again, if we close again, I'm not necessarily promoting here the coal mines, etc., but let us be aware that if we close everything which you or me, might not like, at this juncture, and we don't have actually solutions how the consequences will be handled, that's not wise from the policy angle. So here, again, I just would like to mention that there are trade-offs. Last point, from my side, yes, I fully agree. This is not only about transparency. We have to put the right incentives in place. That's why, we believe that we cannot fix everything with new regulations and tons of new regulation. It's not necessarily true that we focused only on institutional investors and asset managers. Obviously, there is a lot of attention to that. But again, we are also exploring the banking sector and the insurance sector and the prudential requirements and the pension funds. In parallel, we are just focusing on that through other actions in our action plan. So again, we present it in a comprehensive way, and no one prevents, obviously, banks, insurance companies, or pension funds to use the taxonomy. So again, here the taxonomy is not only the tool to be used by one particular sector. This is indeed a tool that we hope, to be used more widely. And again, our role as an enabler, at the same time, also guardian of the financial stability, has to be balanced. I have more points on that I want to say, but I will stop here.
Rens wants to come in, and then I give the floor to you.
Yep.
The people, the audience.
Thank you. I find it very interesting to hear how the discussion within the Commission has gone about this brown taxonomy. At the same time, actually, when we, as Sustainable Finance Lab, talk about bringing in the brown factor in capital requirements, we don't use the word penalizing, because the word penalizing says that you're actually making it a more heavy weighting than, from a risk perspective, actually would be warranted. While in our analysis, we say there with these fossil fuel investments, there is an extra risk. There is this transition risk, which currently is simply not being accounted for. And so if you would give it the right capital requirement, that should be a higher one. And that has not to do with penalizing. As the green supporting factor, I think there the word supporting is much more in the right place. So I think, and that's also what you see happening, because in that sense I understand the ideas from the European Commission, but at the same time this discussion is going on anyway within the community of the regulators. So, for instance, in the Netherlands, the Dutch Central Bank, they are asking very hard questions to financial institutions that have a relatively big part of their portfolio in brown assets. So they're not as far as that they say we give them an extra capital requirement, but that I think they're quite close to it. So if you have a big brown part in your portfolio and you're not able to make clear to the central bank how you think you can manage that risk, and I think honestly it's very hard to have a good story about that, and at the same time say we want to go to stay within a 2-degree world, then you will come to the moment that the supervisor, who does have a mandate to under the second pillar of the Basel Treaty, to just put on extra capital requirements. So I think that's something that we will see happening shortly. But then this brown taxonomy, as I started by saying in my introduction, we are still investing a lot of money in these fossil fuels, and these are simply stranded assets if you believe that we're actually going to reach the Paris Agreement. So in that sense, I don't understand that you would not want to make this brown taxonomy that the sector is doing anyway already. So there are a lot of initiatives from the private sector also to make this brown part of the taxonomy. But by not making that, because you think there might be you might increase in the short term the amount of stranded assets, what you actually might have as an effect is that in the medium to long term you're increasing that problem. So in that sense, I understand from the, so also maybe here there is a little bit of a short-termism, but then within the European Commission, and not to want to take the pain now, but you might be having a larger pain to deal with in the future.
Thank you very much. I would like to turn now to you. I know I have some questions here, but with 1 or 2 thumbs up, it doesn't make a big difference. So I'd like to give you the floor. That's much more interesting. Yes, please.
Hello. My name is Nina Troy. I'm part of the degrowth movement in Germany. Thank you very much for your ideas. So since I am not into financial regulation, but I'm rather coming from a degrowth perspective. And from a degrowth perspective, I'm now wondering, so what's the connection to a post-growth or degrowth society besides the fact that we need a financial regulation and that we need to combat climate change? Because I think the question out there is a lot bigger. Like, how do we change the whole system so it produces social justice and we stay within our ecological limits? And I don't know what the others feel in the hall. Like, I have the problem I had in the former session as well, is that I think it's hard to have a discussion about post-growth issues if the people on the panel are not linked to post-growth questions so far. So I don't want to put a burden on you that you can't answer. I don't know. Maybe you can see, but maybe there's also other people in the hall who have ideas on that. Okay. And in general, I think it would be very interesting to talk about the role of the financial sector and the impediments and structural problems and maybe also power issues in there, and why that hinders us from regulating it, instead of having a very detailed discussion on what is brown investment and what is green investment. And I don't know what about the others here, but I'm getting lost if you go into too much detail. Thank you.
I have to say, very interesting question. It also relates, because that was also the question, it also relates to the broader scope of the seminar, but also how do you look at your own work? How do you actually do this work in a post? I prefer the term post-growth, but that's that kind of discussion. But that means a completely other concept of growth, or you just work within the growth paradigm that we have today, and you try to readjust a little bit here and there in that. All the three of you, I'm going to give the floor, but to the point, please. Yannis, yeah.
Yeah, actually, this was a session about financial regulation. That's why our presentation focused on that. So thanks very much for your question, because now I can talk more about post-growth and why finance is useful for that. So if we talk about post-growth, and we need to take into account that there are various constraints that will take place in the next decade. So we are going to have a problem with growth in any case because of climate change, because of resources, and because of the fact that there are some trends in labor productivity that tend to show that actually growth might not take place in the next decades. So first of all, for me, it's very important to focus on well-being, on full employment, on issues of inequality. And then the question of what is the growth rate that can make these targets possible, this is something that to some extent can be determined in a dozen ways from the system. What do I mean with that? If we try to focus only on growth, and let's say we want to have a kind of degrowth in the next decades and then a stationary state, what is the challenge with that? There are many challenges. First, we need to find a way to control labor productivity. So this is we might decide to have less working hours in order to deal with any problems related to unemployment. But the other issue is that there is a lot of labor productivity that increases because of the fact that firms tend to innovate in the current system in order to make more profits. So one challenge by having a specific target for growth is that this cannot be easily achieved. I mean, we cannot say that the labor productivity in the next years will be something like that, because this is something that is determined by the private sector to a great extent. If we want to have but if we find a way to deal with that, and let's say that we are talking about an economy whereby growth is low or close to zero or slightly negative, The question then is, what is the type of financial system that we want in order to be able to have a sustainable economy? And if we have, let's say, low growth or zero growth, without having massive investments in renewables and energy efficiency, still we might not be able to achieve the 2 degrees threshold. We might pass this threshold because still there will be carbon emissions, and we know that right now, if we don't change the path of carbon emissions very quickly, it's very likely that we will not be able to avoid 2 degrees. So when we are talking about finance, actually, I think that in our presentations we try to say that we need to change the financial system in a way that is supportive to the low-carbon economy. And this will be necessary, of course, in a post-growth economy. We need to have a financial system that contributes to that. How can we do that? As in my presentation, I said that it's very important to enhance the role of public banks and the role of cooperative banks. So in a post-growth economy, this will also be very important. It will be necessary to have a financial system that actually supports the local economies and supports those who want to invest in green projects. And then the question is, are we going to have a kind of financial regulation in a post-growth economy? It might be necessary to have that. Of course, we can have a very different system, but still it will probably be necessary to have a kind of regulation. So when we are talking about the brown penalizing factor or the green supporting factor, this might still be relevant in an economy where we don't have growth, because we need to support green investments. Otherwise, I mean, with our model, we run some simulations with degrowth and then steady-state economy. And if we don't have enough green investment, still we cannot achieve the 2 degrees.
Okay, first give the floor to Rens and then the Commission last.
I mean, I think that was a very clear explanation. So I think the short answer is that the financial system currently thinks of the economy from a paradigm of growth that is possible, for instance, when it comes to carbon emissions. And I think sustainable finance is all about the financial sector understanding that that is not longer possible. So they have to take that into account into their models. And then you get into these things about capital requirements, because that's what's actually driving them. But what drives the change in those capital requirements should be the realization that they cannot simply keep on financing growth of carbon emissions, and the same thing about biodiversity, and so that's really a big mind shift that needs to take place, thinking away from the idea that they could keep on having this growth. And maybe because you touched also on the political economy, the question of the lobby of the financial sector. I mean, that of course is a crucial part if you look at how financial regulation is developing, and that's also something that we could read in all the analysis over about 10 years after Lehman. That just in 2008, 2009, there was a really big momentum amongst policymakers to make big changes, and I touched upon one specific point, which was the idea that we should separate the risk-taking part of banks with the more like the public part of what banks are doing. And in 2008, 2009, almost everyone agreed about that. And then there came this commission headed by Lee Kane. They drafted a report in which they more or less made this proposal. Well, then the European Commission made a proposal based on that. And what you saw was that with every step that I'm describing, those proposals were sort of like watered down. And in the end, the proposals on the table were so thin that people were saying, almost saying, well, we can also just take it away from the table, and what will be lost then? And so in that sense, this lobby is very much a fact of life, but I don't have to explain that to you.
Part of our daily lives. Martin.
I wanted to refrain from mentioning the Likanen's proposal and the Commission's proposal, because I was the one who drafted that proposal in the Commission, and so you can understand my sentiments. But okay, I mean, on your question, we all agree that we need to transition towards a low-carbon, sustainable, circular, resource-efficient economy. For us, this transition offers great opportunities, great growth opportunities, and in both ways. In the opportunities that, we do it in the positive way, i.e. reorient capital flows into sustainable investment. I mean, that's the positive side. But also those activities that will be maybe closed down at some point, they can be transformed in something else. And that's something that I have observed actually in the US last week, that there have been many examples given where actually, again, coal mines were closed and, were transformed into something more positive, generated extra employment. And we believe that this transition that will have to happen, and there where the financial sector has a major role, does offer major growth opportunities. When I listened to, again, you might not necessarily maybe agree with me, but when I listened to Al Gore and Paul Polman, the CEO of Unilever, in San Francisco last week, they both said that basically the sustainability revolution is the biggest revolution of these times that will offer not only to the investors but also to the businesses great business opportunities, great growth, new opportunities they should simply grab that they have not seen anywhere in the past. So for us, we are having the ambition to lead on this file. I mean, in not only in the European Union but globally. For us, this is not only about reorienting the shift of the financial sector. For us, this is really part of the big agenda, which is sustainability, which is competitiveness. If you read again page 1 of our action plan, we are setting the scene, and we are, of course, trying to clarify that this is not only about, financial sector and new regulation and, new approach to financial regulation. This is really about competitiveness of our economy in the area to come. I can elaborate a little bit more, but I understand we have little time.
But I think different answers from a different perspective, but that is interesting, I have to say. But the first there, and then Mr.
Thank you, Nick Mabey from E3G. Kind of very related to that last answer. I mean, one of the, we were a part of the H-leg, and we thought one of the main advantages of that process was it did pull away from the technical detail, and behind it was an idea of giving the financial system a purpose. It's never really been regulated to a purpose before. And I feel, and I think most people feel that, as things become more technical, perhaps those lofty ambitions fall down a bit, and great work's going on. But we are leading into a big election, a new commission, and we need to make sure we have political momentum behind this process. It's a very young process of looking at finance. So just really a simple question to the panel. How would you make sure the new commission and the parliament kept that idea of the financial system having a purpose for citizens, not just for businesses, so rebuilding a social contract with finance? And what would you put on the agenda, which wasn't in the action plan, perhaps was in the H-leg or beyond that? What's the big idea we should be out campaigning for in the coming year, which would make the public think this system works for me, not for them, and delivers things I want, not just things that other people want? That's the big question. There's a little question, which is just the Commission, which is, you talk about the risk of going too fast, but of course there's a risk for the financial system of going too slow. And I wonder, has the Commission commissioned any modelling of the impacts on financial system stability of 3, 4, 5 degrees, which is the current business as usual pattern? Because I always worry in these conversations that there's lots of people saying it's too dangerous to go too fast, but we don't often have that evidence of the other side of the risk management we're trying to do, just a vague thing about 2 degrees, which doesn't resonate in the lobby. So I just wonder, is that something you're doing? And if so, how can we contribute? Because we work a lot with, especially on political risk, around that, and would love to make sure that was fully reflected. So it's not just about floods, it's also about instability in Africa and Asia, which is a critical part of the financial system risk. Thank you.
First, on the action plan itself, it is a plan for this Commission, obviously also maybe a little bit for the new Commission, obviously, until 2022. But we stopped at some stage. And again, we might have even possibly proposed more had we had the possibility actually, to have more war window. But we had to finish with our legislative proposals, as you know very well, by May. Now, we did have other actions on our table. We still do. Maybe I can take it off bilaterally. I personally think that the action plan, in the future will need to be a little bit more beefed up on the S side, because again, we have prioritized quite a lot the climate-related issues, which are again part of E. But I think that we need to again package the ESG a little bit better together. You know, we cannot really see them in silos because, again, as I mentioned, if we do some action on climate, it has by definition also implications on social. And we need to, I think, to see it a little bit more holistically. There are some actions on social, don't get me wrong. By the way, even if we develop taxonomy and climate, there is a social dimension in it. But we are getting many questions, what are you doing, not only from S&D, but we are getting many questions, what actually is the Commission doing on social sustainability? And here I think that, again, what I've learned from last week is that the investors have actually enormous power, also through their active engagement with the businesses that they invest in, actually influence also the way how businesses work, how they, and I think that the financial community, the investors, the asset managers, the asset owners, have huge potential and huge power in managers, the asset owners have huge potential and huge power in a way, I mean, to accelerate the agenda forward. We cannot maybe legislate on everything there. This is something that, again, we would have to do together. But I mean, you know, bringing the two perspectives to the same table and emphasizing not that we don't only work on the Paris Agreement, but we also care a little bit about the other policies about which the Parliament, Commission and the Council care. That's something that I would like to see a little bit more fleshed out, but again, you know, that I'm sure it's coming. And on your question on the age lag, and, you know, I mean, I think actually, again, of course, there were some issues on which we haven't necessarily strictly followed up, but I mean, my assessment is that we followed up on more than 90% of the actions in HLAC. And in some areas we have gone even further. And we have gone even further in linking the different proposals that you have proposed. I mean, by the way, the HLAC work has been absolutely phenomenal, and I would like to really commend all the work. But I think that where we struggled a little bit was to identify the linkages and prioritization, which was not, again, done because of the time constraints. We tried to do that job. In the Commission, we have really tried to, you know, connect the taxonomy with the low carbon benchmark, with the disclosure, etc., and prioritize them. On your question whether we are doing the analysis and some scenarios, yes, we are, for different purposes, for different dimensions. But we are also encouraging the others. You ask, I mean, what you can do. We are encouraging others, I mean, to do the same, because, I mean, we might come up with one answer with a range of outcomes. But I mean, that's exactly why I mentioned that we will now reach out to the academic community. We have already set up a dedicated but we are going back to the technical issues. Technical expert group that will help us with those issues. Because at the end of the day, I think that the Commission, and we try to be really as clear as possible on the objectives, on why this matters, etc. And we need to do better. Then I don't want to be defensive. But we also have to now proceed with the details. Because, you know, the global community, I mean, is looking at us and they tell us, okay, but tell us when it's ready. If the taxonomy is ready, we as a pension fund in Japan, we will use it. But tell us when it's ready. But that now, I mean, you know, we are also in parallel working on the details. And that's not banal. So, I mean, I would only encourage those of you, I mean, some of you might be also representing, I mean, different NGOs, I mean, the industry, the experts, the academia. We are more than happy to engage and leverage on your knowledge and on your research. That's the only way how we can, again, show that we lead globally, really, literally. Thank you.
Yes. Hello, my name is Philip Vergracht. I'm a retired academic from Boston, USA. I would continue on the previous question about the degrowth perspective. And from my perspective, we should not talk about post-growth or maybe a slight negative growth. If you look at the challenges, we really need to think about degrowth. And so what I would like to bring in the perspective of consumption and consumerism. So 60 to 70% of the GDP is driven by consumption. And I represent a network of researchers on sustainable consumption here called SCORA, Sustainable Consumption Research and Action Initiative. And so if you think about consumption and consumerism and overconsumption and the enormous amount of stuff that you consume, the houses become bigger and bigger, etc., etc. You know the stories. We need to reduce this consumption, which means from the financial perspective, that we need to reduce the amount of money that goes into personal consumption somehow. On the other hand, we see, I just was in a session about energy, that we need massive investments in green and clean energy and energy conservation. and we need this money basically to transfer it from the private sector to the public sector. And even that will not be enough. That was the clear outcome from this other session, because we do not address the demand for energy. We just look at the scenarios for energy transition, etc., without looking at our consumption habits, again, that require an enormous amount of energy. So I'm making a full circle here. So my question is, as a non-expert on finance, how do you see the shrinking of the financial sector in the first place, the better control it from the perspective of governments, and the transfer of money from the private sector into public sector and public investments? Is that part of the plan? I'm sorry I missed your presentation of your financial plan, but I'm curious if that is somehow part of the plan. Thank you.
Thank you very much. I must say it's a rather strange conclusion of the former session that you had, because in this Parliament we hugely work on energy efficiency to make sure that our buildings are consuming less energy, our industry is consuming less energy. It's actually the first thing we do before we start talking about renewable energy. So that's the energy transition will never work if we don't work on the consumer aspect of the. But just besides, but it's one of the things that really sounds strange to me. Well, having said that, I think it's interesting also to know what your definition is then of degrowth, of course. To make it quite simple in your what you said about consumerism. I absolutely agree. If you buy a T-shirt, you wear it twice because it's just €1 a T-shirt. You make sure that it's gone and you buy another one, and you do that with a lot of your stuff. That's not the economy that we need. But if you, in a completely other example, if you would be able, which is not the case yet, but that's what we're working on, would be able to produce a mobile phone that is for 100% reusable. You can reuse every single aspect of your mobile phone. Is it then wrong to buy a new phone if you're sure that in the full circle economy, it's absolutely possible to produce new products as long as you don't use new raw materials. So it's more about the concept growth, post-growth, degrowth. It's more about what sort of economy do we need. But having said that, I haven't said that much today, so I wanted to say something. But okay, your question then to the finance expert, which I'm not. Anybody? Yeah, Rens, please.
So your question about the shrinking of the financial sector, that was a question which also put in the discussion before in this room, and I mean that's a very difficult one, because if you had the financial sector, there's many different ways you can measure it, but I think in essence it's assets on the one hand and liabilities on the other hand, and has debts of people on the other hand. So if you would say we want to shrink the financial sector, the people whose debts you are going to forget about, that will not be the problem. So those people will only be happy about that. But of course the problem is on the other side. It's people who are the ones holding the assets. And yeah, well, there are many ways you can do that. It's really the big question, which is actually not on the table. So if you look at what has happened 10 years ago, we had a debt crisis. Well, look at where we are now. 10 years later, the debts have globally only risen. I must say, like, if you look at Europe, particularly in the private sector and amongst the households, they have not risen so much. But especially in emerging markets, they have gone up very high, and also in the public debts have gone up. So it's a very difficult question, and it had in the session before it was said, well, we have 1% of the global population holding almost half of all the assets, so it's quite clear where you need to reduce the assets. I mean, just mathematically, you need to be there. I mean, but there's other possibilities as well. So Yannis brought in his presentation the whole idea of green quantitative easing. I mean, in the end, it is central banks who can create money as well. You can use that money also to reduce debts. And then it's much more unclear who is really paying the price for that. But personally, I think if we get into a next phase of a euro crisis, which I think if you look at the euro architecture, how he was a few years ago and how he is now, then there's no reason to think that we will be better able to confront a debt crisis in one or more eurozone countries. And then I think, well, like the last crisis, you will see that it's mainly monetary policy that should deal with that. And, well, maybe they will start doing things that they did not dare to do the last time, which would effectively lead to reducing debt instead of only increasing the debt as was happening.
I think your question is very interesting because you focused a lot on the composition of output of GDP. So you said that 70% or so of GDP nowadays is consumption. And I think we need to make this discussion taking into account that we need to change this composition of GDP. So you're right that even if we do a lot of things, even if we have a green financial system, even if we invest a lot in energy efficiency, this might not be enough. That's right. It's very difficult to achieve, for example, the 2 degrees target. It's very difficult to reduce the use of matter and reduce the waste that we generate. But we need to try to do a lot of things at the same time. So if we want, for example, to change the composition of GDP, it's very clear we need to change our consumption norms. It's very clear we need to reduce the amount of money that goes into consumption. And we know that this creates also other types of problems. How can we do that? We need to have a financial system that is ready to invest in a green sector, but at the same time is less willing to invest in credit. In consumer credit. And of course, it's not so easy to do that with the current system. But of course, in the previous session there was this idea about credit guidance. So we need to think about these issues and these proposals. We also need to think again more about development banks and how banks can contribute to investment that actually is conducive to a low carbon economy. And when we are talking about the composition of GDP, we also need to take into account that actually there is a very part of that refers to government spending. For example, social care is part of the consumption of the government. And I think that we want to have better services related to social care and health care in the next decades. So this is a part of GDP that we want to keep. So my general view is that we need to realize that we cannot have high growth, or probably we need to have negative growth. I don't know. I mean, it's something that depends on the way that we are going to structure our economy. But at the same time, we need to have these very difficult discussions about the way that we can consume and produce in a way that is not very harmful for the environment. So I would say that we need to think about all these ideas. And not to say that if there is an idea about having green financial system, that this is not something that we have to consider because we need to have the growth. We probably need to have both at the same time.
I have three more questions. Can you keep it short, the questions, and then short answers? But I start here, then there, then there.
Thank you very much. My name is Leonardo Pape. I'm a law student at Berlin University. And so, well, I before also noticed some tensions between the expectations of us revolutionary listeners in a post-growth context and the kind of practical and sometimes technical handling in the panel. But I guess it's most important to understand each other's perspectives from a social role and then the way of how we can connect according to that. So you were touching a bit on the idea of lobby interests, like very practical restraints on policy. and on change. And so, well, from the side of the Parliament and on the Commission, maybe could you clarify a bit, like what kind of influences from a financial lobby perspective and also from other parts of society do you undergo that hinder you from implementing sustainability in your measures? And well, from the more scientific perspective, you may also have experiences of the mentality of the financial sector. And what kind of constraints do you run into there? And what can be done to change that? Thank you.
Thank you very much. I have to say that tension is rather interesting between a little bit the expectation and sometimes the expertise you get here. Because I'm a little bit older than you are. And I learned you need to try and fully understand how it works. And that comes with all the technicalities. You don't have to know all the technicalities, but it's interesting to know how do we do that, the brown and the green taxonomy, to be able to understand the system to change it. It's just not good enough to say degrowth. What do we mean by that? Yeah, you, but not everybody. You have a definition of degrowth, others have the other definitions, and that's I think the interesting part. And it's very good to know how the structures work also here in the Parliament. And I don't work on finance, but I can tell you I'm lobbied day and night. I work on CO2, so I lobby day and night. Recently, the full lobby is on the cars. So I have mainly German car manufacturing, and then via other organizations, and they're hugely successful, I have to say. And an important part, we don't have the time to get into all these aspects, but a very important part is always they try to make a trade-off between climate/environment and jobs and growth. And it's very important to try and to overcome that. And in that sense, there will be a lot of changes in the car industry, and that will affect a lot of people. We have to take that into account. And we have to take people within that transition. And that makes it, in the day-to-day politics, really very, very difficult. But it's important to listen to the different points of view and try to change. But I absolutely agree also on the fact that you need to change the way we calculate our growth. Does anybody want to come in on the...
I would like to...
Yeah.
You first.
First.
I'll try to be super short. I mean, you can take it bilaterally afterwards. Yes, indeed, the Commission is lobbying every day, like the Parliament, like the Council. I mean, that's part of the democratic process we have set. And I think it's fine as long as the Commission, Parliament, Council listens to all relevant stakeholders. When we created, new regulations or new policies, we obviously get 80% of the responses to our public consultation from the industry. And they are very important, they are very valuable, but I think that the revolutionary approach with this file, this is sustainable finance, which again is still the core of this panel, we are trying to talk to many other people. And that's where I see the revolution, because I have been working actually on many reforms after the crisis. And I can tell you that actually I talk now to more people beyond the financial sector than I have ever had. Discussions on. So I think it's a good development. And if you ask me which parties, it really much depends on the interest that individual sectors have. I can tell you that obviously the kind of the brownish sector, I'm by the way going to speak to them and have a dialogue with them tomorrow. They are very concerned that this project might actually stop their financing, their funding. Well, no, actually I will try to present to them that of course, yes, some of the industries, might not be sustainable over time, but we just have to, again, cater for transition, and we have to take it as a business opportunity. And perhaps actually the activities that will be on the taxonomy might also focus on greening the brown sector, because those activities might ultimately actually substantially contribute to meeting the climate objectives. So, I mean, it's not like black and white that we are, again, bureaucrats putting on the list only green, activities that you would normally expect to see, and that this is the niche that nobody would use. But we are trying to make a difference, and we can make a difference also if we, and only, I think, only if we kind of reflect the current situation. The current situation is that there are many industries that are brown, that are making investments in something that we don't want to see, but we will try to help them and to transition them, I mean, on the right way. I will stop here. I have more points to make.
Shortly about the academic research on lobbying, and I mean that research is not very comforting. I think so. That research more or less started about 150 years ago, because that is the first tangible. So the research is about what's called regulatory capture. So how the industry is able to capture the regulator who is actually meant by law to look after the public interest, but in essence, in practice, is working for the industry he's actually meant to regulate. And this letter, 150 years ago in the US, there were the railways, and there was a lot of monopolies and people making a lot of money there. And then in Washington, they decided we want to have a commission who's going to regulate the railways. And at first, the people who were making that money in the railways, they were very much opposed to that. But then, and that is this letter, came from a lawyer of those railway companies, and he was saying, well, maybe it's good to have a regulator because we can simply make him work for us, and then we don't have to deal with all these politicians who are much closer to the electorate. And I think that's more or less what ever since, if you look at the academic perspective, they've mainly been able to sort of like see like, well, that's how it's actually going. And the ratio behind that is that the people working in regulation, they have to work on very specific technical issues. So then the broader audience, and I think, I mean, that's also discussion I hear here, and I very much understand your point of view, but the general audience, they are not able to follow those technical details, so they step out of the discussion. So in the end, the regulator is always alone in the room with somebody from the industry, and he knows that if I now make a decision which is in favor of the guy from the industry, he will not be complaining about that. But if I make a decision which is negative for him, then he might even go bring me to the judge, and that's a lot of work. It's a big career risk, because if the judge says, well, you took a wrong decision, you have a big problem. So all the incentives in that sense for a regulator are there to, in the end, be captured by the industry. And what the research shows is that only after a big crisis, like we had 10 years ago, that's the moment that the regulator really sort of like understands again his public duty, and then they really become servants of the public interest. But it's very easily that again they drift away. And last year, the main regulator of the Dutch Central Bank, he went with retirement. And in his last speech, he very clearly said, like, I'm seeing exactly the things happening now that were happening before 2008, that the industry is again going to the politicians and saying, like, all these regulations is a big burden, we need to lift it, and that politicians are actually starting to listen again to this. So that's not very comforting, but I think, but what comes out of the academic research is you need to be very as transparent as possible, and I think it's very good, for instance, what I hear from the European Commission, that they try to be as, not only talk to the industry, at the same time I know that there's these expert panels, and like 90, if not more % of those people on those panels are from the industry. So maybe one last anecdote. I've been working at SOMO, which is a research organization in Amsterdam, and my colleague was very active in trying to get onto these expert panels. And with a lot of working, she managed to be on an expert panel. And they were going to talk about the new directive, and she had been calling almost every day with the European Commission, can I please see the papers of this directive? And they were saying, no, we'll give a presentation there, and then you can react. And when she was coming there, she was in a room with 44 or 34 other people. They were all from the industry, and each of them had on their table these papers. So they had studied them, discussed them with their colleagues, and she was the only one in the room not able to. So that was sort of like the practice a few years ago. I can only hope that now it's getting better. But I think that's really crucial. That in the whole policy development, that there is much better balance between the people from the industry and other stakeholders.
Key in there is the word transparency, to make sure that everybody knows who's there, who got the files. That's very, very important. No. I have there, and then we finish. Please.
Hello. I'm Christine Lang, studying economics and sociology, and I'm understanding myself as part of the degrowth movement from Germany. I have a concrete question to the Commissioner. You spoke of low carbon emission or a low carbon economy and sustainable growth. Do I understand you right that you believe in a decoupling of economic growth and carbon emissions? And if yes, then I think that's a crucial point, because the degrowth movement, as far as I understand it, isn't believing in green growth or sustainable growth. And you as well spoke about the growth opportunities and digitalization and the digitalization area, if I understood that right, at least. And yeah, that's what we just spoke about in another session, that digitalization, if it's growing as well, it's growing on the basis of fossil resources. It needs infrastructure for that. It needs increasing energy resources for that, and it's based on resources of the global south. So I would like to make that point clear. Yeah.
Thank you. I would first like to, just very quickly, the practice you mentioned is no longer the practice, at least under my supervision in my department, and you can, I cannot invite you to my expert group unless you provide some nice research. But you can see that on the technical expert group that we set up. We have full transparency, and there are obviously many NGOs sitting on it. Obviously, you can always argue we can have more businesses sitting there, but we have NGOs, we have also consumer associations, etc. So that's the first thing. But I had to react to that. Just to give justice. On your question, going back to the financial sector, because this is the focus of this panel. There has always been a premise that investing in something that is low carbon or sustainable, again, perhaps might reduce risk, but ultimately, sacrifices returns and ultimately basically reduces the growth. That has been always the premise that with which many investors and the financial community worked with. This is no longer true. Again, there is a lot of evidence that I have seen as concrete examples that sustainable investments into low carbon, you mentioned, low carbon specifically, in circular, resource-efficient economy, reduces risk, medium to long-term risks, but not necessarily sacrifices the returns, that meaning doesn't necessarily sacrifices the growth, but actually it might even enhance the returns and the growth. I'm just taking the perspective of the investors, because this is what matters. This is the audience we are trying to mobilize here. This is the very purpose of sustainable finance, again, which is the core purpose of this panel. I don't want to go beyond, the sustainable finance angle here, because that's my responsibility here. We no longer live in the world where the investor can say, if I invest in a low carbon sector or low carbon technology, that he will sacrifice returns. We are hearing many stories that actually no, on the contrary, he is reaping the business opportunity that is out there, and he's actually witnessing a lot of growth. And I can tell you that in the US, in San Francisco, I have seen many, many examples. And I would like to see, because I am the head also in charge of the Capital Markets Union, we are trying to help the small businesses and small startups that, again, you mentioned also innovation and digitalization, who actually are very active in the EU, to connect the both angles, the innovative angle, the fintech, we call it fintech, sorry for another term, the kind of innovation that the young generation produces, and the sustainability angle, investing in something which is resource efficient, sustainable, low carbon. So yes, we believe that, that it is perfectly possible to decouple, the usual premise that if you invest in something sustainable, you sacrifice growth, and it's just bad. It's just bad for the whole society.
Last question.
Great, thank you. My name is Elena Hofferbet. I'm from the University of Leeds. And I think I would like to bring in a global perspective, just because the financial system is a global system, climate change is a global challenge. And so I think when you were just mentioning competitiveness, I was a bit puzzled just because I think a system, just a system that is based on competition, a system that is based on profit making, and how far can we actually really acknowledge the global interconnections and therefore look at well, I need to rephrase that. But and how far can we acknowledge the global interconnectedness and the global challenges when we then focus on the competitiveness of certain regions or countries? And so I'm wondering, I would like to invite all of the speakers to just maybe outline in how far your ideas or your work takes into account the global perspective. And then also maybe as a comment more, we just spoke about the necessity of understanding systems, and I think it's really important to understand how the political system works, for us how the European Parliament or the European Commission works, but we also need to acknowledge that these systems, political systems, are embedded and interconnected with the economic system, an economic system that at the moment is based on profit making, on competition. And so I would also like to invite you to comment on the possibilities of radical change in these political sphere in light of that system. Thank you.
Okay, that's a very good question to sum up is go back to the global perspective. Yannis.
Okay, I think the political system is extremely important, and we cannot analyze the economic system without taking into account the political factors. And we also need to have a global perspective because we talk about a global problem. Now, for me, a big issue that we have in practice is that we need to have a lot of public investment, and we need to do this by using the ability of governments to spend. And a very big political restriction right now, especially in the European Union, is that there are not so many governments that are willing to do that because of the fact that public debt is considered to be something bad. And if we take this global perspective and if we also take into account the long-run effects of what we are doing right now, in any case, public debt is going to increase a lot in the next years because there will be a need for adaptation, there will be a need to compensate for those who will be affected by climate change. So if in the political discussions it is not taken into account that we have a very big long-run problem that we have to deal with, it's not possible to change the way we think about debt and finance. And I'm focusing on public debt because I think this is a big restriction right now. So if we want to solve the problem by saying that this is how we can have probably a sustainable economy, by investing more using public spending, but the political system is not willing to do that, then of course we cannot solve this issue. And I also agree with you that when we are talking about a system that tries to increase profits, and I'm also referring to the financial sector, and we know that the financial innovation that has taken place over the last 30 or 40 years was conducive to a lot of stability in the financial system. This is something that we have to change. We cannot say that always profit-seeking activities are good for our societies. We need to impose some restrictions on that. So all these political constraints are important, and I agree with you that we cannot have only an economic discussion, and we cannot have an economic discussion without taking into account the political economy. And just a very brief comment on the previous question about carbon emissions. It's true that someone has to be extremely optimistic in order to argue that we are going to achieve a reduction in carbon emissions if GDP remains high. So it's clear that it's not easy to achieve that. And of course we have to take this into account, and we have to be more realistic when we discuss this issue. At the same time, it's not enough, of course, to have only low GDP, lower than it is right now, in order to have zero or very low emissions. With a low GDP, this cannot be enough unless we have, again, a lot of green investment. So when we are talking about a new economy, this should be part of the story if we want to have very low carbon emissions. So the big challenge is when we are talking about the possibility of having degrowth is that we also need to talk about these issues, how zero or very low carbon emissions will be possible even with a stable or declining GDP.
So on this issue of competitiveness, and maybe that also touches upon this point that Al Gore and Paul Polman are making, like it had this climate change. It's actually a big business opportunity, and at the same time, well, can we have much more economic growth? I think both can be true at the same time, because I think globally the big transition will be about, well, fitting the economy within the planetary boundaries, so making it more climate compatible. And there will be certain companies who will be leading that change. And I think if Paul Polman is saying, I see huge growth opportunities there, what he's actually saying is that Unilever wants to be the one who makes those sustainable products and will gain market share from Procter & Gamble, who does not. So in that sense, you can have, as a company or as a country, a big competitiveness advantage, take a big profit from this transition, and at the same time, you make the transition with the system as a whole. And actually, I think in 30 years' time, if we do achieve to stay within the 2-degree limit, we will see that the biggest changes made in economies will have been in other parts of the world than Europe, and at the same time, a lot of those changes will have been paid for also by Europeans. So I think yes, it is a global issue, but I think European companies, European countries, they can play a very, very big role in that. And then lastly, I want to go into the question of that gentleman there about we have new elections coming up. So how are we going to keep this on the agenda? And I think several times it has been said that there is a trade-off between the E and the S about making sure that the climate doesn't change and the social part. And of course, in the short term, around employment, there are trade-offs. But the bigger picture, of course, is that if we're not able to keep the climate stable, that will be a huge S problem. So I think in that sense there is a lot of a big story to tell, that this E against S is not really the issue. And I think the other part is, what I think we need to keep on the table is to say that this action plan, that this Commission, and again compliments for how fast they have put this on the table and how thoroughly now those regulations are, is only the beginning of really getting to a sustainable financial system. So I think the next Commissioner should definitely understand that he needs to take those make those second and third steps there.
To take them much further, just with the compliments, that's enough to...
Can I still say one
sentence? Okay, one sentence.
Yes. I think that, again, if we make this a success, the financial sector can ultimately influence the businesses, and make it more competitive as well. That's the point that I try to pass across. And globally, we have a big advantage that there is a will of the industry, of the financial sector industry, of the business community, as well as political support. You don't find any other jurisdiction currently globally that has the backing of both sides, or basically of both sides, of all the parties. In the US, there is a lot of bottom-up movement, but basically no political support whatsoever from the top. In Australia, basically some mild support from the regulators, but no support from the government. A lot of bottom-up. Japan, maybe a little bit. China, very top-down, imposed. Europe, we have a great opportunity now. Basically to basically join the forces from the private sector, from the financial sector, and the policymakers together. And that's exactly the competitive edge that the European Union will have in the next 10 years, hopefully.
Okay, thank you. That's oh my God, no, it's 6 o'clock.
I tried to be disciplined.
In the program, it's until 6:30, so I was just wondering if we have time for more questions. Okay, well, if Okay. I don't know, it's always both. So I totally understand that we have to see, like, what do we understand from post-growth and degrowth. But I think from a perspective that I had the feeling was also in the plenary, is that in a degrowth perspective, or in Germany, post-growth would be less be the same thing. We're not only talking about the ecological question, and we don't say, okay, we have to reduce the material flux of our economy, but we're also thinking about the social and the democratic question behind it. So it's a question of equality. You all said that, right? But it's a question of how the economic system that we have, which is a capitalistic system, can actually address inequality. Or is it not a system that will always have inequality like as a very part of its being, right? A capitalistic, profit-driven economy always works with exploitation of human workforce and nature. And if we want to change that, I think we have to change the very system we live in, and also it's about a democratization of the economy and of society so that more people can decide about the policies that affect their lives. And I think that is kind of what I was been missing in this debate, because the debate you say is it's interesting, it's correct, but when you said earlier we have to understand brown and green fragmentation, I think we have to understand the system. The most important point is not to understand every detail. We can have experts who understand the details, but it's about understanding the system. And I've been kind of missing that. And I think that was the question related to rebound earlier also. I totally agree that we need green investment and green infrastructure, and would be totally great to regulate the financial sector in a green way, but that is not sufficient in order to change inequality, address inequality, and democratize the economy and the society. And I think that's why we have kind of having debates which are kindly like off each other. Yeah.
I understand. We take that with us. I just want to give you, I absolutely agree. We had an initiative in Belgium right after the financial crisis to start a corporate bank, the Bank of the People. It didn't work. Unfortunately, I immediately paid a share, so everybody could buy a share. A lot of people did that because they really wanted to have that change. And then it didn't work because one of the reasons, not the only one, but one of the reasons is that the people running the bank didn't understand how it all worked. And within, I think, 2 years, it's gone. And I agree, if you talk about democratization, equality, I think we need corporate banks much more than we have the banks of today that work decentralized and that can finance decentralized new energy initiatives in our cities and neighborhoods, absolutely. But there's something in the way everything functions today that it doesn't work yet. And I agree, maybe for the next, I didn't organize this panel, I'm just taking the chairing because the one who should chair couldn't come. But I agree, maybe it was good to talk about the initiatives of the Commission today because it's a way forward. I think everybody moved up in the discussion, but it was still within how does the actual financing work today and how can we green that a little bit much more? And it's about much more. You mentioned the corporate banks and the government banks, and I think we also need to move in that direction, but that's a personal touch.
May I quickly
yes.
Thank you. I mean, I think that I actually paid attention in my presentation. I think that my second sentence that I said was that sustainability is about environment, social, and governance. And obviously, I mean, I'm very happy to explore social aspects even more. I wanted to make the point about inequality. This project that we have has a huge potential, and for the financial sector, transformative potential of the financial sector to make a difference on the ground. Why or how? Investors can ask the questions to the businesses they invest. How do you deal with social issues? Who are being employed, or who are those that actually deliver, supply the products that you buy from? How do you take care of the social issues? And investors are increasingly asking those questions. They are. I mean, there is a move. I mean, to my taste, maybe a little bit still, I mean, insufficiently, but there is this trend. And again, ultimately, money talks still. And investors can actually exercise a lot of pressures, and by active engagement I referred to earlier, by also making the change on the ground by the businesses and basically even enforce and accelerate the change of the businesses that they seek finance from the investors. I mean, at the end of the day, there are asset managers and institutional investors who are considering not only profit. There are asset managers, BlackRock, Allianz, I mean, ING, by the way, recently announced that they would also, I mean, really consider sustainability as the core objective, not only returns, not only profits. So I think that, again, the role that the financial sector has and the potential it has, the opportunity that it has to influence the businesses and how they actually deal with people and the inequality issues that you mentioned, that can actually be addressed. And there I see a huge potential.
Just a very brief comment on that. I mean, we didn't have the opportunity to talk about inequality. But if we're going to deal with inequality in the next decades, we need to understand what has happened over the previous decades. And when we're talking about inequality, there are various reasons why inequality increased. There were big changes in the social protection systems. And if we compare the social protection systems that some countries like Finland and Sweden had 2 or 3 decades ago with what we have right now in most European countries, there's a huge difference. There's a lot of evidence that shows that actually this has increased inequality a lot. Second, we had a lot of changes in the labor market. Labor unions used to be much more powerful 2 or 3 decades ago. And the wage share has declined a lot over the last decades. And it is related with the changes that have taken place in the labor market. So we need to understand how the labor market institutions should change in order to avoid this reduction in wage share. Third, we had financialization. We know that financialization has contributed to inequality. So that's why we need to have this discussion about the financial system. And we know that, for example, what has happened with the shadow banking system has contributed to more inequality. So we didn't have the chance to discuss this today, but of course all these issues need to be taken into account if we want to design an economy in a society whereby inequality is low.
Now we're moving into the very every aspect of what this whole seminar is all about. But there are other workshops tomorrow. One of them is on trade. Will be very interesting. I hope to see you there again. See you tomorrow in any case. Thank you very much.